Ladies and gentlemen, good day and welcome to Gandhar Oil Refinery India Limited Q3 and 9 months FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nikunj Jain from Orient Capital. Thank you, and over to you, Mr. Jain.
Thank you, Neerav. Good morning, ladies and gentlemen. I welcome you to the Q3 and 9 months FY24 earnings conference call of Gandhar Oil Refinery India Limited. To discuss this quarter's business performance, we have from the management, Mr. Ashlesh Parekh, Joint Managing Director, and Mr. Indrajit Bhattacharya, Chief Financial Officer. Before we proceed with this call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainty. For more details, kindly refer to the investor presentation and other filings that can be found on the company's website. Without further ado, I would like to hand over the call to management for their opening comments and then we will open the floor for Q&A. Thank you and over to you, sir.
Thank you, Nikunj. Good morning, everyone. I am Ashlesh Parekh, Joint Managing Director of Gandhar Oil Refinery India Limited. First of all, I would like to welcome you all for the second earnings call of Gandhar Oil Refinery India Limited to discuss the Q3 and 9-month FY24 financial performance. I would like to extend my gratitude to everybody who has taken time to attend this call. I have, along with me, Mr. Indrajit Bhattacharya, who is the CFO of Gandhar. Before I start with the business update, I would like to give a short introduction of Gandhar Oil to all and for the participants looking at the company for the first time. We are one of the leading manufacturers of white oil in India with a growing focus on consumer and healthcare industries. Our products comprises of more than 440 products which are manufactured across our personal care, healthcare and performance oil division, which is the PHPO division, the lubricant division and the PIO division, which is the process and insulating oil division, all falling under our brand name Divyol. Our products are vital for leading companies in India and worldwide. We serve to more than 3,500 customers spread across 100 plus countries. With 3 advanced manufacturing facilities spanning across 128,454 square meters, strategy located in Western India and the third facility located in Sharjah, UAE, we meet both the local and global demand. The specialty oil market in India is projected to increase from $7.3 billion in 2023 to $9.3 billion by 2028, reflecting a CAGR growth of 5%. In the evolving market scenario, white oil it plays a crucial role in propelling the fastest growth of the Indian specialty oil market. The demand for white oil is propelled by the increasing usage of personal care products, pharmaceuticals, and the food processing sector. At Gandhar, the emphasis is on the R&D remains a pivotal aspect of the company's growth and innovation strategy. Our commitment is to utilize our R&D expertise in nurturing growth, generating values, and enhancing our standing as a foremost provider of intelligent and sustainable solutions across diverse industries. A short glance on the Q3 performance. Our revenue and volume in our largest segment PHPO has increased by approximately 11% from 520 crores in Q2 to 581 crore in Q3, and our volume has simultaneously increased from 64,609 kiloliters to 71,602 kiloliters. Our EBITDA has increased from 75 crores in Q2 to 85.12 crores in Q3. Similarly, our profit after tax has also increased from 48 crores in Q2 to 51 crores in Q3. We witnessed a strong quarterly performance in our overseas sales, which has increased by a whopping 23% in revenue from 574 crores in Q2 to 705 crores in Q3. Similarly, our overseas volume has also increased from 64,000 kiloliter in Q2 to 81,000 kiloliter in Q3, which is roughly around 26%. We remain dedicated to our growth plan and are preparing for the future. The expansion of our facilities in Taloja and Silvassa is advancing very smoothly, and we anticipate its completion by end of this fiscal year. This strategic initiative will not only allow us to venture into new domains, but also facilitate production of a diverse range of products for not only our new existing customers, but also to focus on our new customers. Further, fueled by a resilient financial position, expansion in the manufacturing facilities, and with a diversified product portfolio, we anticipate substantial growth prospects not only in domestic front but also international markets across our business verticals. In conclusion, as the global specialty oil market evolves, white oil takes the center stage with its exceptional growth trajectory. With stringent quality standards and expanding global reach, white oil proves to be a pivotal force shaping the industry's landscape. In coming years, we have confidence that the strategic position will drive consistent growth, allowing us to generate significant value for our stakeholders. With this, I hand over the call to Mr. Indrajit, who is the CFO, to take you through the financials. Thank you once again.
Thank you, Ashlesh bhai. Thank you everyone for joining this call. I'll take you through the financial performance of the company for the period ended 31st December 2023. In the quarter gone by, our consolidated revenue from operations stood at 11,026 million as compared to 10,010 million in Q2 FY24, 10% growth. For 9 months FY24, our consolidated revenue stood at rupees 31,740 million as compared to rupees 30,923 million in 9 months FY23. Our total, as Ashlesh bhai said, our total overseas sales for Q3 FY24 stood at 7,086 million, comprising 64% of the overall sales, as compared to total overseas sales of 5,746 million in the previous quarter. For 9 months FY24, the total overseas sales stood at 19,748 million, comprising 62% of the overall sales, as against 16,702 million in the previous 9 months ended on 31/12/22, which constituted 54% of the total sales. Our consolidated EBITDA for the quarter stood at 851 million as compared to 759 million in the previous quarter. For the 9 months ended on 31/12/23, our EBITDA stood at rupees 2,451 million. EBITDA margin for the quarter is 7.7 million as compared to 7.6 in the previous quarter and 7.7 for 9 months ended FY24. Our consolidated profit after tax for the quarter ended at rupees 512 stood at rupees 512 million as compared to rupees 480 million in the previous quarter. For the 9 months FY24, our profit after tax stood at 1,535 million. The PAT margin for the quarter was 4.6 and 4.8%. The manufacturing gross margin spread stood at rupees 10,223 per KL compared to 10,060 per KL in the previous quarter. Thank you all. That is all from my side, and we can now open the floor for the questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Rushabh Shah from O3 Wealth Asset Management. Please go ahead.
Hi, am I audible? Hello?
So your voice is echoing. Are you on speakerphone?
No, I'm on the headset phone. Am I audible now?
Yes, sir. Go ahead.
Yeah, so I had a couple of questions. In your presentation, sir, you stated that the Indian white oil market is 0.47 billion in FY23 and the industrial oil market is 3.2 billion. So, any particular reason for concentrating particularly on the white oil market and gain market share in a market which is so small, the white oil market, and why not concentrate on such a big market which is the industrial oil market?
This is your question, right?
Yeah.
This is the only question you have, right?
No, I have 2 more questions, sir.
Okay, so you can tell me the questions. I'll try to answer all of them together.
Okay. And so, as we are watching that there's a slowdown in the FMCG space since the past quarter due to the results, we are seeing such a slowdown. So even Gandhar oil would be affected due to such slowdown in the FMCG space. Just wanted your views. What do you think going ahead for the next 5 years? And my third question is, then how do you see Gandhar oil growing ahead for the next 5 years? I wanted to know your growth trajectory and what steps are you taking to take Gandhar oil ahead?
Fair enough. Coming back to your first question, why white oil and why not focus on the lubricant business? See, white oil is a part of our PHPO business, which is the personal care, healthcare, and the performance oil division, which is our largest business division. Now, for entering this the white oil space, with the FMCG customers, there is a time process of more than 4 to 5 years of empanelment. So, there is a high entry load, there are barriers to entry in the business. Compared to the lubricant business, which involves, more B2C marketing, more of advertising spend. And with the growing advent of the EV, we anticipate, automotive sales, maybe after 5 years, 6 years will start coming down. So the company would really want to focus on the personal care healthcare division, where there are entry barriers to the market, where we have marquee customers, not only domestically, but even internationally. Coming back to your second question on slowdown in FMCG space and the view of Gandhar over the next 5 years, yes, we've seen, we've tracked the FMCG results, especially for Hindustan Lever. They've registered a flat growth in the volume. But at Gandhar, see, we are concentrating our strategies, not only domestically but internationally as well. Our exports, our overseas sale, as I just informed you in the earnings call, has increased by more than 20% on revenue basis and more than 20% in volume basis as well. So, we are, there is a perfect blend of domestic and export sales, which is helping the company to the newer horizon in the coming years. Third point, we are, internally contemplating on formulating new products, for our customers, and our R&D team, in tandem with the R&D team of our customers, are formulating new products which are, being well accepted by the market. So at Gandhar, for the next 5 years, we want to focus on the PHPO business and enhance our product offerings to this customer.
Okay, so just to follow up on the first question, you said the industrial oil market, there are many players into the market, and Indian white oil market, there are a lot of entry barriers. So wouldn't industrial oil market have entry barriers, or do you see a slowdown in the automotive space going ahead?
See, as I informed, with the advent of EV, the use of lubricants, for the automotive oil, would definitely come down. Because there, in the EV two-wheelers or four-wheelers, there are no lubricants which are primarily used. There are, the volume is more, less than 70% as compared to the current usage. So obviously the demand for the lubricants for the automotive oil will definitely come down. Second point, industrial oils, transformer oils, there are not such high entry barriers. The time taken for empanelment, is not like 5 years as we have in the FMCG businesses. For us, to get into a pharmaceutical company or a cosmetic company, the empanelment is pretty huge, like 5 years, because there's lots of process involved, there are plant audits involved, there are consumer trials which are involved, which goes beyond in approving a product. So if you see any product out of the shelf, there is a huge process that goes behind. So companies, multinational companies would definitely don't want to switch suppliers, with, small changes in the pricing. That is why I'm telling there's a high entry barrier, specifically for the PHPO business. And the last point, the important point, the working capital in the other businesses are pretty high compared to the working capital cycle required in the PHPO business. This is why, we would like to focus on the PHPO business as such.
Okay, and sir, if you would just, my last question is, what would you define the key risks in your business except being the crude oil volatility or crude oil pricing? Any key risks you would like to define?
See, as such, the company has been strategically focusing on the PHPO business, and in the risk that we pursue in the business, as we had shared in the presentation, obviously with the crude risk, there is a price pass-through contract with our customers. We have term contracts with our suppliers. These are the 4 risks that we pursue, as I told you. The foreign exchange risk, we have, overseas of more than 64%, which acts as a natural hedge. And for the balance, we do forward contracts with our banks, so that is also minimized. The third point is the credit risk, but with, the product, more than 440 products being sold to more than 3,500 customers, to global, not only domestically but internationally, the liquidity risk is evenly spread up. The credit risk is equally spread among the customers. And if you see our database, like the top 5 or 10 customers won't contribute more than 10% or 15% of the total revenue of the company. So, the credit risk is very, very, very minimum. And the liquidity risk, we have sufficient liquidity, to take care of the business going forward as well. And there are no long-term debts also in the company.
Mm-hmm. Sure. Thank you so much, sir. I'll come back. Thank you.
Thanks.
Thank you. Next question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Good morning, Ashlesh bhai. Thanks for taking my question. I got few of them. Sorry, I got into call late. Apologize if I'm asking it on a repeated basis. One on the other income. Other income has fallen from 17 odd crore in 3Q of last year to 1.8 crore or an 18 million in this quarter, and it's lower even in the last three quarters as well. If I look at the trend, so what is driving down the other income?
Sanjay, this is Indrajit here.
Hi, sir.
Hi. So the other income in the previous quarters constituted dividend income received from our subsidiaries.
Okay.
So then that is not there in the current quarters. That's
and
the main
how much
reason.
was that?
It's about, I remember, about 3.5 to 4 crores.
So it's 3.5 to 4.
Check that and get back to you.
But if it was a subsidiary, it should not come in consolidated financial, right? Even consolidated financial, it shows 16 crores of other income versus 1.7 crore in this year.
Okay, let me just check and get back to you on that one, Sanjay. So it is basically 1.6 crores currently as against 16 crores in 22.
Correct.
Yeah. So I'll have to check that and get back to you.
No problem. My second question is on the Texoil, which is basically your console minus standalone. If I look at that performance, revenues, yes, we have grown much better than the standalone business with the growth of 20%. But gross profit margin has shrunk from 9.9% to 7.3%, and actually absolute EBITDA has declined by 15%. Can you help us understand what has changed in the Texoil business?
So, Sanjay, let me explain this to you.
Yeah.
As you see that the top line has increased, the sales have increased. Now we had to resort to buying on spot basis from distributors to meet our increased commitments to our customers.
Okay.
So this buying on spot from distributors has resulted in our buying at terms which are not so favorable. This has impacted the gross margins, which has then come down all the way to the EBITDA and the PAT. Its main reason is because of the increased requirements of raw material we had to go and buy procured from the spot market.
Just to add, Sandesh, on what Indrajit just informed, we are in touch with, if you see the standalone numbers, Gandhar Oil, we had a super impressive performance, if you see on the standalone basis, thanks to the contractual commitments we have with our suppliers. Simultaneously, we are trying to mirror the same contractual commitment, from our suppliers, even for Texol. So the work is already underway, to expand, the contractual volumes that we are getting for Texol, looking at a growth perspective in the future as well. So we anticipate, the Texol numbers also to improve in the near quarters.
Okay. And I thought the entire reason we were going into the Middle East region was to take the benefit of the favorable supply situation. That's still work under progress, or how should we see how many quarters it may take for us to normalize the situation?
Yeah, see, even at Gandhar, if you see with the 35 years of history we had, we've improved our buying efficiency over past 4 years. I mean, yeah, Texol is fairly a new company, fairly just a growing baby now. But having said that, with the support of Gandhar, Texol is now having access to the refineries. There are contracts in place. But refineries, won't start. If, for example, if I want 100 units, the refineries won't give me the 100 units altogether in the very first year itself. They want to ensure, whatever contractual obligations Texol is giving to the refinery are honored. So you start with so if I want 100 units, they will start with 20 units or 30 units for the first year, then gradually improve or increase the volumes depending on the performance of, of the company with that specific refinery. So obviously it won't happen overnight, but it will take next couple of quarters for it to, be it on its toes and, continue buying its raw material primarily from the refinery.
Can you help us understand how much do we buy directly in the standalone versus the distributor, and what is the ratio in the Texol today?
I don't have the exact number, but I mean, just to give you a guesstimate of the contractual versus the spot buying, I think it would be around 60% would be contract, 55% would be contractual commitment, and balance would be spot.
This is in the standalone or in the Texol?
No, I'm talking about Texol.
Okay, Texol. And what will be in the standalone?
Standalone would be 75%, more, in fact, excess of 75% would be contractual buying.
Okay. Thanks on those numbers. One small request, Ashlesh bhai, if you can also give us the manufactured volume, we will really appreciate, because that gives us a full picture. You are obviously stating the gross profit per kg, but if you can also give us the manufactured volume, that will really help us in understanding the business a little bit better. And I don't know if I'm asking more, even the PHPO share we will really appreciate, because the whole thesis of us is that we want to become more stronger in the PHPO. And for us as an external investor, it will be really helpful to see the journey along with the numbers.
Yeah. So I have some volumes, which I can offhand share it with you. So our manufacturing volumes of Q2 was 120,457 kiloliters, which has increased to 131,213 kiloliters in Q3 FY24. Now, coming to the PHPO, our volume in PHPO was 64,609 kiloliters, which is in Q2, which is increased to 71,602 kiloliters in Q3.
Got it. That's fair enough. And my whole request is, if you can put it in the presentation, we will be ready with the quality questions and don't ask a numerical question on the call. But super helpful. One last question to Indrajit sir. This other expenses has declined from 43.6 crore to 40 crores. What is driving the drop in the other expenses? Because I can see volumes have gone up quite handsomely. Any reason why the other expenses have come down?
Well, other expenses constitute a whole list of expenses, mostly on the selling and distribution and the miscellaneous and the other types. So there has been economies of scale achieved because of this increase in our top line, which has resulted in reduction. So there are expenses in this space like forex cost, there is expenses like storage and all that, which has definitely been able to be brought under control because from the previous year.
Got it. Fair enough, sir. That's it from my side, and thanks for answering all my questions patiently, and best of luck for the coming quarters.
Thank you.
Thank you. Next question is from the line of Rohan Gupta from Nuvama Wealth Management. Please go ahead.
Hi, sir. Good morning. Thanks for giving the opportunity. Sir, first question is once again on the consolidated minus standalone. So, given the reason that there has been more spot purchases which has impacted the gross margin at the subsidiary level, I think that is more driven by the volume growth, and there is a huge difference between the EBITDA margins or gross margin which we are enjoying right now on a standalone basis versus the subsidiary. Like at a standalone, we have already reached to almost a gross margin for the current quarter of as high as 14.7%, versus just only you can say 7% at subsidy performance. So, do we see that when we start getting from the refineries the desired volume of raw material, the subsidiary margins also will be aligned with the standalone margins which we are doing right now?
Thanks, Rohan. See, the endeavor is, to ensure and enhance our buying, directly from the refineries, to reduce our spot buying, from the distributors or traders in the market. So obviously, the performance that we have witnessed in the standalone basis in Gandhar, we anticipate the same to be replicated even in Texol once, the buying patterns, primarily shifts from more of contractual buying than for the spot buying.
In what time frame you think that, because I think that at the time of IPO news itself, we have been mentioning that now you have already have a size at the subsidiary, and with the benefit of under the Gandhar, you will be directly procuring from the refinery. So, by what time frame you are expecting that we should be able to see those kind of margins?
See, as informed earlier, refineries, would treat Texol and Gandhar as two different entities because, the requirement of Texol is different, requirement of Gandhar is different. So they want to ensure, they are aware the box is ticked in terms of, Gandhar Oil, being able to honor its contractual obligation in terms of volumes, in terms of, payments on time, etc., etc. Similarly, Texol is fairly a new company. We started contract with few refineries, with few of refineries there. Obviously, being their first year, obviously they would not, give me the 100% of my requirement. But the idea is, to move our total contract buying in terms of the contract size requirement, anticipate, to be completed in the next 2 or 3 quarters. That is, the plan going forward.
Okay. So second question on the industry related, as you have already mentioned that most of the FMCG companies are talking about the slightly lower growth also coming from the rural side. So in this kind of scenario, do we see that there is any volume growth risk to our numbers in near future, and how you are basing yourself with this kind of weakness as far as the India market?
See, I definitely track the results of, this FMCG companies, where they've registered a flat volume growth. In spite of that, we have seen 11% volume growth in PHPO from 64,000 KL to almost 71,600 kiloliters from Q2 to Q3. So, the endeavor is, to enhance our offerings with our existing customers, and also, at the same time, our team is focusing on, acquisition of new customers as well. So, that is a work in progress which is happening, and we are very sure that, the team is confident about, achieving similar kind of volume growth in the future quarters as well. And the last point is the geographies as well. So, as you are well aware, we are exporting to 100 plus countries. So, the growth, the buying pattern, or the growth in FMCG business in India would be different compared to a growth in Africa or South America, So, we are trying to cater to the growth internationally to ensure the growth plan, the strategy that what we have devised at Gandhar are focused on, and, we try to achieve the numbers that what we have envisaged.
So you are saying that with the expansion in the product basket and adding the customers will ensure our volume growth that what has already been in the Q3. Is it also the reason that probably if I adjust for your margin in the subsidiary where it had been under pressure, standalone margins on a per liter basis, gross margin per liter, which was roughly 10 rupees per liter last quarter, would have improved once again to more than 11 and 11.5 rupees under current circumstances in Q3? And is it mainly driven by the product mix change or any other particular reason?
So our manufacturing gross margin in standalone basis was 10,000 rupees per kiloliter in Q2, which has increased to 12,200 rupees per kiloliter in Q3.
From 10,000 last quarter, right?
Yeah, from 10,000 last quarter to 12,200 this quarter.
This significant improvement of almost 20% on Q on Q. So it is what? It is driven by any raw material cost advantage or any other benefit, or just product mix change?
It's a combination of, couple of points, obviously strategic efficiency in buying of raw materials, key customer accounts that we have, expansion of business with this customers. These are the two key reasons, and obviously focus on overseas sales. So these are the three reasons what I contribute to, the increase in.
And this is going to remain there, the sustainable margin.
The endeavor is to not only maintain but to improve.
Okay. Thank you, sir. Thank you, Chris. Thank you so much.
Thank you. Next question is from the line of Amit Kumar from Determine Investments. Please go ahead.
Yeah, thank you so much, sir. Just one question, given your very wide, export footprint, I just wanted to get a sense, all these Red Sea, trading disruptions that, we are seeing. If you can just sort of qualitatively or quantitatively if possible, but at least qualitatively, what sort of an impact, is it having in terms of your business, in terms of sales, in terms of supply chain and margins as well? If you can just help.
Right. Obviously, the Red Sea issue is a globally known issue. We are closely monitoring this issue. We are, our team in constant touch with the customers. Appraising them about the situation. Communicating them about the increase in the freight. The customers have also been understanding in terms of the reasons of this issue of this hike in the freight. And to a fair extent, we are trying our best, to pass on this cost to the customers.
So there is one element in terms of margin, but in terms of your supply chain also, because you have a factory in UAE, and that's the sort of hotbed. So in terms of availability of raw material, in terms of delivery schedules, is that on track, or have you seen any sort of disruption on that as well?
We have not seen any headwind in terms of supply chain, in terms of raw material specifically, from our suppliers.
Okay, got it, understood. Thank you so much.
Thanks.
Thank you. Next question is from the line of Aditya from Securities Investment Management. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So if I look at your volume on a year-on-year basis.
Sorry to interrupt you. Can you speak a little louder, please?
Yeah, am I audible now?
Slightly.
Yeah. So if I look at your volume on a year-on-year basis, they have decreased by 2%. So if you could just help us explain what has led to this?
Just a minute. So our volumes have grown from year on the quarter-on-quarter basis. It has grown definitely. It has grown from 64,000 from 1,21,260 to 1,31,000 in this quarter.
So I'm talking on year-on-year basis. So last year the volumes are around 1,35,000, and this year it is around 1,32,000.
Yeah.
So this is a 9 month compared to 1 year you're doing?
No, sir, quarter-on-quarter.
I'm just adding this. There was a trading component which was involved in the previous year. We have reduced our trading volume. So if you compare it on the manufacturing volume has definitely gone up, compared to previous years.
Okay. And so second question is regarding the base oil prices. So if you could just help us understand how the base oil price is trending, considering we are seeing sharp reduction in crude oil.
As informed earlier, we have been in a position, to buy our raw material based on index-linked buying. So, whatever changes in the raw material are there, is based on an index, which publishes the price weekly, and our pricing from our base oil suppliers is based on the indexes which publishes the ICS pricing.
So, sir, what I wanted to understand was when the prices decrease, the pickup from the customers also reduces. So are we seeing that sort of trend playing out currently?
See, as of now, if you see our Q3 performance, our volume has, our PHP volumes has grown by a whopping more than 20%. Our overseas sale has improved. So obviously, even with the reduction of the crude, I don't see there is an absolute correlation or an apple-to-apple transfer or reduction in sales because of the softening of the raw material pricing.
Okay. And sir, we have seen very nice pickup and growth in exports for the last 2-3 years, and this trend is being seen by other listed peers of us as well. So if you just help us understand what is leading to such high growth in exports for all the players?
See, I would like to focus on Gandhar. We have been focusing on the PHPO business, with the profile of the customers, with the quality of customers that we have. We are endeavoring and trying our best to expand our footprint, with the existing customer, and also, strategically focus on acquisition of new customers. So we envisage, the growth, this kind of growth would continue in the future as well.
So but has structurally something changed in the industry which is helping Indian players to export more, or the competitive dynamics have changed in the industry?
See, as informed, talking about Gandhar, we have witnessed a strong growth, and we've with the quality of product that we are supplying to our customers, the demand for these products is increasing from our customers, and we are getting new customers because of timely delivery, timely service, and the right quality. So this is what we see even repeating in the near future.
And so which are the major geographies where we are seeing such good growth in exports?
So, obviously the demand from APAC and Americas continue to drive our overseas sales.
And sir, are we selling directly to brands, or we are selling to distributors who in turn sell to customers?
So the model that we have, is a combination of direct supplies to end users as well. And with some countries, there are, some distributors in between, or in turn supplying it to the end users.
So in our major geographies, what would be the proportion of direct versus distributor?
Sorry, it would be very difficult for me, to give you such kind of detailed analysis in terms of, selling to the distributors and selling it to the end users. But, having said that, we have more than 3,500 set of customers, and 55% of the total revenue, more than 55% of the total revenue is still from the personal care, healthcare division. So the company strategically will be focusing on the PHPO business for its future growth and expansion as well.
Got it. And sir, in PHPO business as well, is there any margin differential between supplying to a pharma segment, or supplying to a cosmetic, or supplying to plastic segment?
No, so there is no such difference in terms of supplying, to FMCG to pharma. But, obviously, PHPO overall margins are better compared to the other businesses. For example, in lubricants, if you see, the advertising costs are far higher. In other industries, for example, the process and the insulating oil segment, there is high inventory, there is high debtor days. So obviously, the focus of the company is on the PHPO and to manufacture more value-added products for our customers.
Okay. And sir, is it possible to give a breakup between sales between MNCs, regional or local customers?
No, it will be very difficult, to give such kind of data. It would be a bit. It's a little bit confidential data. It will be difficult to share.
No, so just wanted a rough range about a split of sales.
I will check and get back to you, if we can provide this data.
Sure, sir. Thank you for answering my question.
No problem. Thanks a lot.
Thank you. Next question is from the line of Nihar Shah from Crown Capital Partners. Please go ahead.
Yeah, hello. Good afternoon, sir. One question on our financials, like our revenue has seen good growth. Like till now we have done 31,740 crores. So can we close the year around 44,000 crores?
See, the endeavor is to grow in terms of the revenue, in terms of profitability. Having said that, we witnessed a good growth in quarter 3 compared to quarter 2. So obviously, we'll try our best to, target this and, ensure the same is reached. But then obviously it's more of a futuristic answer if I had to give. But the idea is, the strategy of the company is very clear in terms of the PHPO and, to focus its revenue, its volume, its growth on the PHPO business. And we'll try our best to achieve the set growth plan.
Okay, and also our EBITDA has been stable around 7.7, 7.6 mark. So can we say these are the sustainable numbers and can grow on from here?
See, historically, Gandhar has been in a position to, if you go back to the history, over the past 4 years, 5 years, we have been in a position to achieve EBITDA of over 8% as well. So the endeavor is to ensure the EBITDA margins are not only sustained but even improved.
Okay, sir. Thank you and all the best.
Thanks.
Thank you. Next question is from line of Surya Narayanan from Sunidhi Securities and Finance. Please go ahead.
Thank you for giving the opportunity. So one thing, as I said, that nearly 2/3 of operations are Indian, whereas nearly 1/3 is Sharjah. So still, what is the issue in getting the Sharjah unit getting accredited from your suppliers? Still, you are saying that now still 55% are on the spot basis, the rest on contractual basis. Rather, it should have been easier for the Sharjah unit to get the contractual basis than Indian. So, what is the thought process? And how long it will take to get entire process from the contractual?
I already actually answered this question, to one of the participants of this call, but obviously I'll try to answer it again. See, the idea is, to ensure, buying of Texol is primarily from the refineries. Today, as informed by Mr. NVG also earlier, that, because of the volume commitment to our customers, the contractual commitments were not in place from our suppliers. Suppliers, work a little bit differently because they want to see, they want to, start slowly and steadily, because once the refinery commits a volume, no matter what, the refinery would definitely go ahead and supply it. But refinery, would not, buy my full buying, refinery would not, commit my entire buying, on the very first year. They would like to, monitor the performance. They would ensure that whether the supplier, whether the customer is in a position, to fulfill its contractual obligation, only then try to increase the volume slowly and steadily. Similarly, if you see at Gandhar also, it's a 35-year-old company, but we've managed to get contractual commitments from our suppliers only over past 5 years, past 4 years or past 5 years. So obviously it takes time, once we are there into it, then obviously there's no turning back.
So when can we expect the contractual things to pan out in Texol? For the second half of next year?
The idea is, the endeavor or the buying team, the supply chain team is, constantly in touch with the suppliers, to improve its buying from the refineries. It would be difficult for me to give you an exact date as to when or which quarter it would be happening, but obviously, the idea is, obviously we at Gandhar also would want to ensure that, it happens yesterday than today.
So if it happens, let's say on a full year basis, if it happens, then how much effect it will have on the EBITDA margin or let's say gross margin?
It's pretty easy, to calculate the math. If you see, you've seen the performance on standalone basis of Gandhar Oil. You've seen, if you just minus the Texol, you'll come to know, what performance Gandhar has delivered, So obviously, you can work out the maths and you'll get a clarity on what it could be.
And you said the current quarter out of 132,243 kiloliters. So around last year there were some trading element. So what percentage was there in last year's revenue? Let's say on the volume wise. So can it be quantified?
I'll check and get back to you. I don't have the data upfront in terms of what was the volume of FY23 in terms of trading, but I'll check and get back to you.
Okay. And last year, the last quarter, we saw that the majority of the other expenses are booked in the fourth quarter, and resultantly the EBITDA and as well as the PAT, declined significantly. So what has led to that kind of situation, and whether that kind of situation is going to pan out this year?
There is no such thing that majority expenses are booked in the fourth quarter. The expenses are booked as and when they are income and on a uniform basis. It's only some provisional entries which are passed in the fourth quarter, which is beyond what is income. We do not agree with the fact that they were all booked in the fourth quarter.
Because the this paid at the gross level was not affected. So it was around last quarter was around 10,413. So it is quite good. So despite that, the EBITDA suffered due to the higher other expenses. So that is the reason I'm asking.
Couldn't understand your question.
Pardon?
Couldn't understand your question.
my question is that what has led to the spike in the other expenses in the fourth quarter of the last year, which led to a drop in the EBITDA?
It's just as and when they were incurred.
Yeah.
There is some provisional increase there. There's nothing which is a spike and all that.
Okay. And sir, year to year, you are saying that during our IPO meet, you are saying that the company is striving to get into a level of around 11,000 to 12,000 rupees per kiloliter. I mean, there is a gross trade. But we are nearly far off from that, and our top gross margin around 11,430 for FY13. So again, it is gradually it is dropping, and just in Q3 it has just improved to 10,233. So what I was checking from the people who are, or let's say companies who are actually focusing on the industry side or let's say auto side, their realization is around upper of 94 or 93,000, whereas our realization is around 84,000 and 10,000 lower. So resultantly that has impacted. So what I wanted to ask is that whether the focus, because what I saw is that it is quite a blending activity, operationally. So if it and it is quite fungible. If it was fungible, then when a situation permits, then can it be not focused to the industry side or also auto side, so that to get higher mileage out of that?
Okay. See, our endeavor is to stick to the PHPO part of it only, because that is the biggest growing segment of the lubricants business. Like Ashlesh Bhai had explained earlier in this call, the automobile lubes is going to decrease slowly. Industrial does not have industrial and RPO and transformer oil is calls for huge blockage of working capital. So we expect our main focus to stay on PHPO. We are not right now looking, in spite of it being fungible, we are not looking at turning it around to the other verticals.
So may I know what is the asset turn in the lube and lube and industry versus the PHPO?
We'll have to get back to you on that.
Okay. Okay. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in the interest of time, that was the last question. I would now like to hand the conference over to Mr. Nikunj Jain for closing comments. Nikunj, may I request you to please go ahead?
Yeah, I would like to thank the management for taking the time out for this conference call today, and also thanks to all the participants. If you have any queries, please feel free to contact us. We are Orient Capital Investor Relations Advisors to Gandhar Oil Refinery India Limited. Thank you so much.
Thank you very much. On behalf of Gandhar Oil Refinery India Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you.